Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. It's been a little while since I put a video out. I've been pretty busy. I spent a long time on the article that this video is going to go over. It came out about a month ago in May, right after the Berkshire Hathaway annual meeting. I spent quite a bit of time writing the article, a couple weeks, and which is always, usually I don't spend that much time writing articles. You never really know how they're going to be received and if anybody's going to read them. But this one did really well. And I just kind of get into a lot of things that I don't normally talk about. Usually I write valuation articles, occasionally some theoretical articles. And this one got a little bit more into kind of Buffett and Munger and the current state of the economy, and it's called like 5 takeaways from the Q&A, but it really goes deeper and wider than any of that and tries to kind of take a lot of different questions and themes and bring them into 5 digestible sort of takeaways. And then I definitely have my own kind of take on a lot of this, my own interpretation, which is different than quite a few people that I think don't really understand Berkshire very well, or Buffett and Munger very well. But it was received really well. So people really, a lot of comments were, this is the best article of the year and things like that. So it was definitely worth me taking the time. And I'm sorry I haven't made a video about it yet, but I've just been really busy. So I'm just going to go through it. It's probably definitely worth actually reading the article, but I'm going to cover some of this and give everybody kind of a taste. It's actually been a while since I wrote it, so I'm going to have to remind myself what I was writing, a few weeks ago here. So the number one theme is the stimulus boom is over. I think Berkshire Buffett pretty much said that. He came out and talked about an extraordinary period as having ended. So, and they're seeing it in some of their operating businesses where they ordered a little bit too much inventory, and now they're trying to basically put it on sale and get rid of it because we're not in the boom period anymore from the stimulus. He also notes that goes along with this that cash is not trash. So he was talking about buying treasuries. Let's see, what did he get? He was able to get one, I don't know what the term on this was, but it was a short-term treasury for I think it was maybe only a month or two, but 5.92%. This was back in May, before the debt ceiling thing was resolved, which he said, of course, it will be resolved, basically. So he felt like he got a pretty good deal at almost 6% bond equivalent yield for treasuries. And this has been a big change where basically you got zero on these short-term treasuries for the past decade or something like that. And I think that's a really important takeaway for people to understand. We are definitely in a different environment. Granted, inflation and services and core and services inflation, I like to look at core inflation because energy can affect a lot of, and the supply chain stuff affected a lot of the good stuff, which is coming down now. But we'll just call it roughly equal with the yields that you can get in treasuries, which are in between 5 and 6% in the short term. And so it doesn't cost you anything to hold the cash. And if inflation comes down or we start to go into recession, you'll actually be making money on your cash. And chances are, when that happens, I don't know exactly when or the rate that it will happen, but the Fed will probably keep raising rates until it does happen. So, and until there's going to be a lag between the time it actually shows up in real life and then the time that it's measured by economic measurements and so forth. So there's a lag there. So you're probably not going to lose money, even in real terms, in short-term treasuries of like a year or less, unless something really kind of crazy happens. So cash is not trash anymore. You're not losing money in real terms with cash. and I've been a big buyer of T-Flow, which is probably linked somewhere around here, which is yielding above, I think the SEC yield is above 5% now for that. See if, here it is, yeah. iShares Treasury Floating Rate Bond ETF, right? So I have about, let's call it 45% of my individual investing accounts where I can pick individual stocks, like not a 401k. About that percentage of that money in my family's accounts is in treasuries right now. So I think Berkshire's about 20%. They've been there for a long time. So that 45% is collecting about 5% yield right now, just doing nothing. And it will do that even if we have a recession or stagflation or whatever. So I gave you the example of Tyson Foods here as a stock that I kind of made a mistake on. I identified a lot of this boom bust from the stimulus, which is still playing out because student loans, which I probably will mention here at some point, they don't start being repaid back until September. That's been an ongoing stimulus for 3.5 years, I think now. Yeah, about. So even though it's not a stimulus that's being paid out, it's just a stimulus because it hasn't been having to pay back in. It's still it's been a stimulus to the economy. And so when I realized that eventually these loans were going to start again, they could have started as early as early 2022, and then they've been delayed. So I basically positioned in early January, December 2021, January 2022. I went through and tried to get out of all the positions that I thought were kind of part of this boom and that could experience a bust. Well, Tyson Foods was one that I got wrong. I owned it. It was in a boom bust. I wouldn't have expected necessarily to be this bad, but I thought it wasn't an extreme case, and I thought that they probably could keep their pricing power. But the truth is, once stimulus money started to run dry, they couldn't keep the prices of meat up. People just wouldn't pay it. So without that stimulus money. So as the stimulus money ran out, also wages, I'm sure, rose as well for workers. For them, and that combination basically just created a bust. So I've sold this one now. I don't still own it, but I definitely took a hit. I think I took like a 30% hit on that, and that was one I wasn't able to identify. But I used it here as an example of this boom bust thing. We are in a bust. I mean, this is just a food company. It's not a super cyclical company. I mean, so when you see earnings drop, like maybe I can click it and look at it. I'm not sure, 82% or something. Let's just see. Like I said, 82% that hasn't actually happened yet. That's what analysts expect this year. So when you see that out of like a food company, I mean, that's a bust. That's not like a normal economic cycle thing. So you should definitely look in your portfolio and see if you have any of these. I've written a lot of them are kind of dropping like flies, like steadily, but you never know which one it's going to be on each earnings report. The last one I think was Dollar General, fell 20 or 25% in a day. So you can see that's probably going to continue up the income scale. At least that's that's what I think, and that's why one of the reasons I have so much cash. But all right, so that was the main thing. There was a boom. We're now in the bust. It's not like super fast. It's kind of a slow rolling thing so far, but we're definitely in it, and Buffett thinks so too. He didn't necessarily say we were in a recession. Charlie seemed to think we probably were going into it. He would seem to be a little more negative on the economy. So understanding debt borrowers and lenders. Okay, so this is a good one. This is one I talk about a lot, kind of in the Cyclical Investors Club, just because it's a different understanding and a way to frame things, especially with regard to the job of the Federal Reserve than most people have. So back in 2012, this quote always stuck with me, but when the Greek debt crisis was going on, so basically Greece had borrowed a lot of money they didn't have their own currency. They used the euro, so they couldn't just like print money like the U.S. can, and they were having difficulty paying back that money or even the interest on the money, I think. And so there was a big kind of crisis in negotiation, particularly with Germany, who tend to be the loaner of the money. What should be done? And at the time, Buffett said, the EU can't be half slave and half free. And so that framing of debt situation really kind of stuck with me. I mean, in some ways you intellectually know it, but to frame it as slavery when debt gets to a certain level is I think it's a pretty accurate way to think of it. And if you've ever read like The Snowball and follow Buffett a lot, he usually tries to avoid debt unless it's structured in a particular way. Even during the meeting, he said, like a mortgage is fine, like a fixed rate mortgage is okay. But most other debt should be avoided, and definitely credit card type debt should be avoided. And so I talk about that. We talk about the government in terms of the U.S. government's ability to borrow, because we've been borrowing a lot. They both agreed that we don't know what that ultimate limit might be, where maybe people kind of start to abandon the dollar and refuse to buy treasuries and government bonds. And they were like, we don't know exactly what point it is, but we don't really want to get close to it. I mean, we have a pretty big advantage because we're kind of the biggest, most stable economy in the world, but it can go badly. And they were like, you don't really want to get in a situation, which I think is fair. Buffett sold all of his banks except for Bank of America. We have the kind of the banking thing, which this was a little closer to it back then. Again, this had to do with the structure of a lot of the commercial real estate debt. I actually learned a little something here. I didn't realize a lot of these were non-recourse loans. So basically, as Charlie pointed out, they'll come out of it with a different set of owners. So the people, basically the borrowers for commercial real estate, so the owners, if they get to the point where they just aren't making money, they just give the building back to the bank and just let it go. It's just done. And so now the bank has like a building and they need to find a new owner for it. And usually that's not a very profitable situation for the bank. And so that was something worth kind of paying attention to. He does still own Bank of America because he said he agreed. He kind of offered them a deal at the time that he originally bought. I think it was during the financial crisis. There might have been another thing. And I think he felt, since he was the one that approached them with the deal, that he should just stick it through and just hang on to it. And he's like, they're a good bank or whatever too. So, now in terms of kind of the moral things, if Buffett thinks debt's bad and slavery, he did point out that he owns that they own American Express. So I mean, they're involved in this business on the other end, and so it's more like this is how the system works type of a thing. And you want to be on the side of, you don't want to be on the side of having too much debt unless you have a really great structure like a fixed rate mortgage or something like that, which is kind of rare. He also pointed out that Berkshire acts like a bank. Berkshire's insurance companies act like a bank that don't have the deposit flight risk that a lot of these other banks were experiencing, and kind of one of the benefits of the way that they're structured. Let's see here. Oh, he also noticed that the Federal Reserve wasn't the problem. It was really government spending, right? And he thought a 0% inflation target is better than 2%. Now, this is actually a good quote. Nobody wants a lot of inflation except someone who has a lot of debt. And this is worth thinking about. And I try to explain this whenever I can to people. But whether inflation is good or not, or bad or not, or whatever, it really comes down to the individual position that you're taking. If you're a lender, which is what the Federal Reserve represents, banks who are lenders, You do not want inflation because you get paid back in dollars that you lent out that are worth less than what you lent them out at. So in real terms, you can base in purchasing power, you can lose money even though you get your money paid back to you. Okay? And so if you're a borrower and your wages roughly keep up with inflation and you have a fixed rate mortgage or something, inflation is not bad. The value of your home or whatever is going up and your wages are going up, but your interest rate stays the same. So if you have like a 3% mortgage and inflation is 5%, that's a benefit. That's a benefit to the borrower. It's not a benefit to the lender. So a lot of what the Federal Reserve does, is my view, is they protect banks by trying to stop inflation, okay, on one end. On the other end, they also protect banks by trying to make sure the economy doesn't get into a situation where too many people are defaulting on their loans. So that's the other way a bank loses money. They loan out money and then they don't get it back because it's been defaulted on. And so that's the balance the federal, and then just keeping the general financial system working, So that's the real mission of the Federal Reserve. I don't think this should be controversial, but people really focus on the full employment or maximum employment and price stability, right? These are what the words that they say. Well, the price stability is to make sure that money gets paid back that's not worth a lot less than it was lent out at. And the employment is a proxy for defaults, okay, for too many defaults, especially relative to the amount of interest that was charged at the beginning. So when too many people can't pay back their loans, we get like the financial crisis, right? Because banks loan out like 10 times more money than they actually have. So that's just the way the system is, and the Fed is supposed to try to look out for banks, protect them from themselves, and protect them from kind of wider calamities. The Fed is not there to protect employment, right? So this is why occasionally we'll get in a situation like we are now where unemployment is pretty low, right? Inflation is relatively high. The Federal Reserve is not going to stop raising interest rates, or they're not going to lower them at any rate until inflation actually comes down. They don't care whether people have jobs or not until they can't pay back their loans. So people got a lot of stimulus. Some of those people have spent it all. Some of them still have it. But until we get to the spot where there's too many defaults for the banking industry to kind of handle, the Fed is not going to be lowering rates. They aren't going to lower rates because of the unemployment rate. They're only going to lower rates if inflation's high, if the defaults increase too much. So I kind of get into some of that here and explain it as best as I can. There's price stability, there's everything else. You can read it if you want a more clear, precise explanation than I just gave. So that's just important to keep in mind. So what it boils down to is I think the Fed is going to keep raising rates until inflation freaking goes down, man. I mean, if you loan money out at 3%, you can't have inflation at 5% year after year. And some people will say it's way higher than that and everything. But if you just look at core inflation, I think it's still around 5. A lot of money's been lent out at rates that are lower than that. So that can happen for a little while, but it can't go on for too long. And the Fed's job is to make sure that that doesn't go on for too long. And they'll follow through because they're run by banks. Okay, let's see. The need for a mutual beneficial relationship between business, government, and society. So this is kind of a good one, but it's a little ephemeral, I think. Buffett's kind of calling for like a balance here. But Berkshire receives a lot from the government in terms of creating an environment where Berkshire can make, a profit and money and improve things and so forth. Buffett usually says the government is more important in that respect than for Berkshire than Berkshire is to the government. However, he also noted in the meeting that, or maybe it was in his annual letter, that oh yeah, here it is. Yeah. Berkshire pays a lot in taxes, and if there were 1,000 businesses that paid as much as Berkshire, there would be no need for any other taxes at all, like income tax, Social Security, like nothing. And so, I mean, I think he's making the case that while America is more important to Berkshire than Berkshire is to America, Berkshire is kind of doing its fair share in terms of funding the structure. And if there were a lot of other places doing the same level of contribution Berkshire was, I don't know if you wouldn't say like things would be better, but he's trying to say Berkshire's basically paying their fair share. He also noted that we've become more tribal politically, and that tribes can turn into mobs. We have to refine our democracy, but also noting that the world is better than it ever had been. Munger replied, he's slightly less optimistic than Warren is. This has to do with just kind of the politics and the temperament and various relations in society. I agree kind of with both of them. I think I'm slightly more negative than Buffett is right now. Just with social media and AI and the way our democracy and elections are structured right now, it lends itself just to, we've seen what it lends itself to. I mean, I don't know if I have to get into that. I mean, if I even mention Disney in the article, I'll have like 10 comments, people talking about Disney. And usually when I mention it, and this and their Iger, or now it's Iger, it's actually Disney versus DeSantis or whatever. I think it's dumb. I don't even think it's worth even wasting one bit of energy on me. But just saying that will piss off people on one side. It'll piss off the people because I don't care as much about what they care about, And I've been bearish on Disney for forever. But I still think I just think it's kind of dumb. So we're in a situation where, or in an environment where neutrality is hard to, or indifference even is hard to, is a hard position to stay in. Even if you stay in it, people won't think you're really neutral or that you don't actually care, So, yeah. And so I'm a little negative here. I think another thing that the Taiwan Semiconductor selling of his Taiwan Semiconductor right after he bought it basically really shows that the relations with China have gone down. Risks have risen enough where he would change his mind that fast. He didn't go into a great amount of detail, but he basically said, look, Japan looks better than Taiwan as an investment right now. And I think this has to go with when you have a big risk with a low probability of that may have like just a moderate probability, but the result is disaster, then Buffett usually tries to avoid those situations. I also point out that he kind of did the same thing with airline stocks back in 2020. He noted he could tell that longer term profits, it would take a decade for profits for most of these airlines to just break even from the amount of money they were going to lose. And a lot of people gave him a hard time for selling kind of toward the bottom here. But if you look, and he bought back a bunch of Berkshire shares instead, and Berkshire's outperformed all of them. If you average these, they're like half of what Berkshire's returned of the major airlines. I don't know, that looks like a pretty good call to me. And I did the same thing. I didn't buy any airlines when they had this big spike. A lot of people thought, problem solved. But if you looked at the earnings of the airlines, you could see that they were hemorrhaging money, and it was going to take a long time for those earnings to actually make up for the losses that they had. So it's a similar thing, I think not exactly similar to the Chinese risk, but if you have those big event risks, they can kind of outweigh any moderate gains that might be there if they occur. And once the probability gets high enough, then even if it's not super high, if it's high enough, it's worth getting something safer. I think that's the main message there. He didn't go into as much detail as I did, so I'm definitely reading into that a little bit. Let's see. Oh, they talked a lot about salesmanship, avoiding salesmen, recognizing how people manipulate one another, and then resisting the urge to, once you know that, to use those techniques on other people. I thought it was pretty. If you read, I can't remember the name exactly, but it's like The Power of Persuasion or something like that. It was a good book recommended by Charlie in his book. That kind of shows some unusual. I'm not sure what would be the best term. Like, not, you wouldn't immediately think of some of these persuasive techniques, like charging I'll give you an example just from there. So if there was like a jeweler and they realized that they actually sold more jewelry out of this case if they doubled the price or something like that compared to like putting it on sale, because the perceived value that the customer had when they looked at it was more, because the price was higher. So it actually created more demand for the higher priced product. Putting it on sale actually sold like less or something like that. And so those little kind of quirks that are, you wouldn't necessarily think would be true are those type of things. And they're in that book. If I remember their title properly, I might not have. Yeah, so I was already getting into the salesmanship paradox. And I mean, I have that too. Buffett noted that most of the, I was going to see if I could actually find the quote here. I don't see it. But yeah. Basically what he was saying is selling people, a lot of money managers and people in the financial industry are making more money selling like ideas and things like that, or themes, and rather than actually making money because of the performance of like the actual investments that they're making over a longer period of time. And so it's really the salesmanship that's being rewarded financially a lot of times, rather than the real performance of the capital allocation, right? And so Buffett thought that meant, because of this and it's very short-term focused. Here it is. The big money is in selling other people ideas. It isn't in outperforming, right? And I think that's very true. And he also thought the world is short-term focused. So he thought this could create opportunities to put money to work. Munger was a little less optimistic, where he basically said there's so much money in the hands of so many smart people, and they're all trying to out-promote one another, that it's going to be pretty hard to find like really good values, because there's just so many people, they're very smart, they're looking for them. Buffett seemed to think because they were short-term focused, they would make mistakes that would allow opportunities for Berkshire to put money to work. I'm kind of agree with both of them. So, I mean, it's hard. The market is pretty efficient most of the time, and usually the market knows a little bit more than the average retail investor, I would say, most of the time. And so I would say maybe invert this a little bit and say it's easier for a retail investor to make mistakes on things that look pretty good to them, even if they have the right intentions and a pretty good, decent process, and even if they're long-term focused, the chances for error are pretty high, because the market does tend to be pretty efficient, and the really good ideas the smart people definitely know about. So it makes it hard. You're just not going to be able to find those great ideas really cheap very often. So you kind of have to have some different approaches. I have a growth strategy where I just try to look longer term basically and get those. It's not really a value strategy. It's pay an okay price for hopefully really long term performance. And I basically had to do that because unless I wanted to run a pretty concentrated portfolio, which I don't, I needed, I wasn't getting enough deals basically. So, and we haven't had a recession a real recession since 2009. So, and we're in 2023. So we're 14 years in. That's double how long it usually takes before you have a decent recession. And that can create opportunities, but it's a long time to just sit around and wait on the best deals. And it's good if you can get a mix. So I tried about 1/3 of the portfolio is now geared toward these very long-term, longer growth, more volatile. You have to try to predict farther in the future. And I think the reason I had to do that is because Charlie is right. But then I also have strategies where I can pick up short-term mistakes, like my cyclical strategy that the market makes, which I still think happens on a regular basis. Well, I just bought AMD last fall when it was 65% off its highs. And so it's more than doubled in 8 months. And some part of that move is irrational. Either the drop was irrational or the rise since then was irrational of the market. So those type of opportunities exist, but they can be really lumpy. It's hard to manage a portfolio when you're dealing with sharing it with other people. When you can have a couple years where you maybe don't, if you're really strict, you could have a couple years where you hardly buy anything, and then in 3 months or whatever, you can have one after another. And so having something that's a little more longer term and longer focused does make sense, but there's a lot of smart people out there. And so you have to be really patient and willing to accept a lot of volatility and a higher level of mistakes with the hope of a bigger reward. And so that's not easy for investors to do either. So I try to mix the two of them together, and it's going okay. But I wouldn't describe any of it as particularly easy for the average retail investor. I also point out the kind of paradox, which is I have to write articles like this and make YouTube videos like this. I'm selling stuff. I try to stay as focused as I can on performance. Usually I start my articles or videos with how I did on something in the past or how my ideas worked out. So I try to keep everything grounded to kind of medium-term performance. But it's hard when you look at it's hard. You still have to be seen in order for anybody to hear you. And there's a lot of other promoters out there, right? I had a list of them that I just scrolled past. Here we go. So let's look at the salespeople. They try to get you to focus on anything other than investment results, like medium or long term, usually. So we have a promising technology that'll change the world, like the internet, mobile internet, then crypto, self-driving cars, artificial intelligence, biotech, like the CRISPR stuff, and RNA vaccines, and whatever is hot at the time. Streaming video was gigantic for a couple years. New emerging markets, and basically whatever the next big thing is. And I just named off a bunch of them. So these are all stuff that now did I get artificial? Oh, I did get artificial. How could I miss that? So yeah, the new one, artificial intelligence. So there's always something out there where you're focusing on the story rather than the economic fundamentals, the real potential, and the ability to actually predict which companies are going to be the big winners. It's a lot easier to sell these stories than it is to write a boring valuation article like I usually write. So it's a challenge. You have to work and you have to sell a little bit in order for people to see you. And then it's also difficult to outperform. And when you haven't had a recession and you're kind of defensively positioned, which I often am, So even if somebody is looking at the performance and saying, okay, how are these actually doing? It's hard, even if you kind of make sense to people, if they look at the results and at that particular point in time, you're trailing the index a little bit or something. That can be hard too. It's hard to outperform the market over time. So it's not an easy gig if you're focusing on actual returns. But you can do it, and there are enough smart people out there, or people that kind of have lost trying the other stuff, where they're like, okay, let's look for somebody who's maybe not trying to just completely sell me, extract as much money out of me as they possibly can, which I try not to do. So I get into all that. I get into a lot of that here. Buffett and Munger had a pretty good exchange about Ben Graham and Geico. Munger was a little critical, pointing out that Graham made half his money on Geico. This is sort of Munger's thing, where he's like, most of you don't need to diversify, blah, 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 for most people. I halfway agree with him on that. I wouldn't diversify just for diversification's sake, but most people aren't as smart as Munger, and I would say it's better to let your winners run and let your if they grow into an oversized position, that's fine, but you shouldn't just sell them because they've done well, but that most people aren't as smart to start a concentrated portfolio, and you don't want to make like a couple mistakes, especially when you're still learning, and have it wipe out your portfolio either. So Buffett made the point that, look, if you have a good system like Graham did, and you stay in the game long enough, you're going to have these kind of Lollapalooza effects come along where you're going to get something like ultra right. And so that's basically, Graham would have done fine without Geico. I mean, he would have, I don't know exactly what his returns would have been, but they were good. And so there's a lot there. And the environment just changed where it was harder to find those kind of classic Graham investments too, which Buffett realized and changed a lot of what he did. So there's a lot of back and forth there. But I think the staying in the game, don't make mistakes that are going to take you out of the game. I owned a Signature Bank, and it went bankrupt. And I had sold almost all my other banks near the peak. Decided just to take a chance on that one, and it went to zero. But because I have an unconcentrated portfolio, I guess I collected like a 2% dividend. So I lost 98%. But it was a 1% weighted position, which isn't still fun. I still don't like to lose. But, I think since 2020, we've had 29 positions that have doubled or better. 29 that have doubled, and of those 29, I think 3 were triples. So if you're taking chances like that, for the big returns, you're going to have to accept sometimes that it's not going to go your way, and then just, even if you're not taking chances, every now and then. Now, certainly, if you're only investing in the Coca-Colas of the world, it's probably not going to go to zero. You might just lose your money slowly over time, but in no way did it ever even take me out of the game or even come close to it. I mean, you almost didn't even notice it. So I would keep that in mind. Stay in the game, have a process, improve it, and who knows, maybe you'll hit the next, monster beverage and just hang on to it just as part of your process, and your portfolio will end up being 50% bigger than it otherwise would have, because you managed to get one of the big ones, one of the big future winners. So that's what I kind of think about that. Learning from mistakes, understanding consumer behavior. This is a good one. I was trying to think. I think what Buffett was saying here was, he's just been doing this a long time, and I know he referenced Apple, but where he understands kind of consumer behavior, and that can give him insights into kind of things, and he's learned that over time, But you learn that from your stakes. He talked about the shopping mall that they bought in Maryland and how they probably had more fun just doing that, and they ended up losing. And then on some of the investments that worked out fantastically, and he's like, if you got a hole in one on it playing golf every time, it wouldn't be very much fun. So just learning, improving, making mistakes, that's part of the process. It kind of goes back to the just the kind of staying in the game type of a thing. He talked about Oxy, which is interesting. I haven't bought this one yet, but I've been watching it ever since Buffett got interested in it. I think he has some. I think basically he thinks Oxy can control the marginal price of oil, at least in the U.S., by adding or reducing capex. And I think he also thinks they probably are going to be able to do enough carbon capture to sell carbon neutral oil at a premium. This is just my theory of what's going on here. Because he noted that there were others. Oxy has some other things too, a lot of good things. So the big question mark is, what are those other things, So I think that's it. It's also a kind of inflation protection. If there is any kind of oil crisis like in the 70s, which given international relations right now, there could be. So I'm watching Oxy. I haven't bought it yet, but he definitely thinks there's a lot of what Buffett does is he tries to get his money returned to him quickly. Okay, his capital returned. So if he invests $100, he wants the company to earn that $100, usually in free cash flow, back quickly. 10 years seems to be he 8 to 10 years. 10 is kind of the max. I think if he had his choice, it'd be really low if he had his choice. But in this environment, at 8 years of return. When he bought Apple, it was kind of in that. I think it was around 9 when I looked at it. And then so he likes to get that money returned basically to the business that he's invested via earnings or free cash flow or whatever. And then he likes to have some option on future growth after that. So you get your money back quickly. You can look at this in the way he structures debt too. So he'll issue debt at 9% or 10%, and then which will return your money back in about that same time, 8, 9, 10 years, before 10 years for sure. And then on top of that, he'll usually get warrants. Well, that's his option on the future. So if the company can continue to do well beyond 10 years, that's just the extra money that comes back. So he gets his money back and he gets a bonus. And he basically just repeats various forms of that. And he's been doing it. I went back and studied this phenomenon back to the Coca-Cola purchase. And that's when I first kind of picked up on it. And when I looked at almost everything else, in his mind, that's kind of how a lot of it works, And it's not aiming for the big, it's getting your money back and then getting a bonus on top. And then if you can get that bonus a long time, it's better. If you can get more of that bonus, that's better. But get your money back first, right? And it might not necessarily be all the way back. I don't think Apple they haven't paid a dividend all the way back for his investment yet. But if you take dividends and buybacks, and the fact that Apple is a very strong business, and they probably are going to have the option on the future, okay, now you're just ignoring the stock price. I'm not even talking about the stock price. I'm just talking about earnings. Now you have that kind of classic Buffett setup where between buybacks and dividends, he was probably getting in whatever earnings were left over. I think he bought when it was the PE was 10 or something like that. So that's good, and then if Apple comes out with some new product, like maybe their headset that they just came out with, now you have growth from the future and you get your money back. So it's worth looking for things that are kind of set up like that. I think he understands consumer behavior enough, is what he's saying, that he can predict some of these patterns, and maybe some of the patterns that don't work might even be more important than the ones that actually do. So if you have 3 businesses, IBM, which he sold actually and then bought Apple. If you have IBM and you have Apple and then you have whatever, he could look at consumer behavior maybe and say, okay, Apple is going to be the way that consumers are going for a certain period of time, and so I'm going to put my money there, even if it's at the same price as IBM. I don't know if they were. I think IBM probably was at a similar PE as Apple, but it's gone nowhere. So you can see that. You can kind of see that pattern there, and it comes with time. I'm not super great. I'm learning. Usually you learn from your mistakes. Like you buy a certain type of stock a couple times and it doesn't work. It looks like it should work out and it doesn't work out well, and you're like, okay, maybe this just whole type of business just isn't really as good as it looks sometimes, or it can change too quickly. It's something to think about. So this was a long article. I really think the article is much more articulate than my video here, where I just kind of scanned through it. So I'll leave a link and you can give it a read, and then I'll have a link for the Cyclical Investors Club. It's $30 a month, and you get all kinds of, you get to know everything I'm doing and what valuations I have on all the stocks I track, and chat me anytime and all that kind of stuff. So you can check that out too if you want, and I'll see you later.